Every life insurance policy, which is a contract, plainly states that the owner of the policy, who is the person that pays the premiums, outranks every potential borrower in access to the money that must be lent. So what does this mean? This means that the owner has absolute control over the investment function of the company. The insurance company can only invest the money if the owner of the policy does not exercise his option to use the money instead. So what can the owner use this money for? Anything he wants. Now listen closely, because you are about to see the power of becoming your own banker. Remember that 8.5% car loan that ultimately cost you 25%? Instead of buying that car today, if you fund your bank for the next 4 years by making premium payments into your permanent life insurance policy, you will be able to borrow from your own bank, which is the cash value in your policy, to pay for the car. Then, instead of making payments to the automotive financial company, you make the payments to yourself by making the payments back into your policy. To maximize the power of becoming your own banker, you must pay yourself at least the amount of interest you would be charged by the automotive finance company, preferably more. What does this amount to? Let's assume you'll buy a new car every 4 years for the next 44 years, so 11 cars total. Each car will be financed for $10,550 and can be financed at 8.5% interest for 48 months. You have a choice with how to pay for these cars. You can use one of 5 methods. You can buy them through a bank or other finance company, lease them, pay cash for them, use an interest-earning savings account, or use your own bank by using the infinite banking system. Let's look at each method in further detail. Buying the car through a bank at 8.5% interest would cost $260 per month, which is $3,030 per year. Over 44 years, that amounts to $137,280. Leasing a car costs a little bit more. Why? Because you lease from the owner of the car. Is the owner a fool? No. He will make some money on the activity. Let's then assume that leasing will cost you $175,000. Paying cash for the cars will first require you to save up for the car, so you would have to defer buying the first car for 4 years. The overall cost for the cars would be $116,050, which is the $10,550 times 11 cars. The last 2 methods both involve having a banking mentality. The difference is using your own bank versus using someone else's. Let's compare. Assume that for the last 2 methods, you understand the need to capitalize your bank, so you accumulate $5,000 per year for 7 years before purchasing the first car. You could accumulate your money in a savings account and buy certificates of deposit at someone else's bank in the amount of $5,000 with a yield of 5.5% interest. However, this interest is taxable, so the after-tax effect is 4%, assuming a 30% tax bracket. After 7 years, you would have $41,071 in your account. So you buy your first car and continue making the $3,030 car payments into your savings account. By year 50, you would have $258,927 in this account. Alternatively, you could accumulate your money in a dividend-paying permanent life insurance policy instead of at someone else's bank. For the first 14 years, putting your money in someone else's bank comes out ahead. But from that point forward, the infinite banking concept is favored in an accelerating fashion. In fact, by year 50, you will have $964,638. That's $705,710 more than putting your money in someone else's bank. Why is this? Because when you become your own banker, you are the only owner of your bank, so you receive the profits that would otherwise go to the bank. It's that simple and that powerful. There really is no comparison. Plus, by using a dividend-paying permanent life insurance policy as your bank, you get the other inherent benefits with life insurance policies. Namely, the dividends paid on a life insurance policy are not taxable. The money you borrow from the cash value is not taxable. And the cash value is protected from creditors and judgments in most states. By becoming your own banker, you will soon be in a position to stop supporting the employees and shareholders of other banks and finance companies through all the interest you're paying to them, and instead use that money to support you and your family. Becoming your own banker will prove to be one of the wisest decisions of your lifetime.